Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast. Hello, Vision Nation. I hope you're doing well and keeping healthy. In this week's episode, we're going to discuss some of the main takeaways from a book called 100 Baggers. It's written by Chris Mayer and is a great read for anyone interested in investing. 100 Baggers are stocks that return 100 to 1. So for every dollar you invest, you get $100 back. I want to start off this week's episode with a story about a really unexpected 100 bagger. The story is about Monster Energy and how it became a 100 bagger in 2006. I was really surprised to learn about this in the book. I had no idea that this company had such a great run. So let's dive right in. These two guys, Hilton Schlossberg and Rodney Sachs, came out to California. Rodney was a lawyer from South Africa and he was looking to make an investment, but he wasn't really sure what industry he was going to focus on. He was kind of shopping around for the best opportunity available. They saw this company called Hansen's, which was a tiny Southern California soda company, and they bought it for around $15 million. Hansen's was originally a natural juice company that was founded in the 30s. Well, Rodney wanted to change that around completely. The vision he had for the company was to shift from making niche sodas to making commercial energy drinks. He wanted to have mainstream appeal and to sell tons of volume. Hansen's, by the way, was the original name of the company before it was later changed to Monster. Around this time, Red Bull started to make waves in Europe, and Rodney figured that America might have the same sort of boom in energy drinks as well. They created a Hansen energy drink, but it didn't really do too well. It seemed like Red Bull beat them to the punch for the 8-ounce market. The 8-ounce cans are those small, slim cans, and Red Bull spent a ton of money on sales and marketing and ended up overwhelming Hansen's energy drink. That was a failure for the company, but it was also a great learning experience. They realized that to succeed, they really need to focus hard on exactly what they wanted to accomplish. So they decided to focus on the energy drink market and cut out a bunch of other product lines that they had. This is an interesting theme as it reminds me of when Steve Jobs came back to Apple after being fired. He also cut out a ton of products at Apple and focused on the few that would create the most value. That's exactly what Rodney did at Monster. In 2002, Rodney redesigned the drink formula and the branding. They spent a lot of effort polling teenagers and consulting with a brand executive to get the branding just right. That's when they came up with a 16-ounce Monster energy drink. This time, they marketed Monster Energy super aggressively. The number of sales and marketing employees went from 60 to 600 in just 5 years. They were really experimental with how they sold their products, and by throwing lots of ideas against the wall, some ideas stuck and worked really well, like the promotions they did at extreme sports competitions and concerts. They also figured out that most of their customers were men, so Monster used their branding to appeal to men. They used a dark can because a white, light, or silver can was more appealing to women. The book goes pretty in-depth into the financials for Monster Energy around this time, and there's some obvious trends that you could see. Their sales grew by over 600% in 4 years, and as they got to be a more established brand, they also stopped having to offer so many discounts. That combination led to a higher return on equity. The return on equity is just a fancy way of saying how much income the shareholders earn from the money they invested into the company. So the return on equity went from around 11% in 2002 to 44% in 2006. So their sales, profits, and return on equity all increased. This book highlights how that's the recipe for getting a 100 bagger. In a 100 bagger, you usually have sales increasing quickly, and if the return on equity increases at the same time, and you get multiple expansion, that can really create a big stock price increase. Their stock went on a tear, In 2001, it was around 7 cents. And by 2006, there were stretches of time that the stock was over $7. So there's the 100 bagger right there. By the end of 2014, the stock turned into a 700 bagger. The interesting thing is that there were still lots of top analysts saying that the company was overvalued and overhyped. So there were still people that were really bearish on the company even after it proved a really good track record. What this case study highlights is that 100 baggers don't always happen in the trendy industries. Monster Energy was creating a new product category in a space where you have massive companies with established distribution networks, and they were still able to make a huge success of themselves. So, as I've mentioned, 100 baggers are stocks that return 100x your initial investment. Invest $1 and you get $100. Invest $10,000 and you get a cool million. Now, the author is not promising an overnight success, and he openly says that it's hard to find these 100 baggers. For his research, Chris Mayer, who's the author of the book, he looked at every 100 bagger from 1962 to 2014, assuming reinvested dividends. There were a few different books and research papers written about 100 baggers in the past, and Chris essentially took out the most important concepts and put them together into this one book. I'll include a link to the book in the show notes. So what are some common traits of these 100 bagger type companies? 100 baggers show big increases in sales. That makes sense because if you're buying a small piece of the business, the clearest way that your ownership of the business will increase in value is if the whole business grows. So if the business is having big growth in sales year after year, that's a great sign. Another thing they have in common is good returns on equity. That's a fancy way of saying that the business makes a good return on the money that investors put into the company. And this is an actual metric that you can look up. So you can look up return on equity or ROE for different types of companies. The biggest difficulty in getting a 100 bagger is not selling too early. As an example, in his 1995 shareholder letter, Warren Buffett talked about buying Disney stock for 31 cents and selling it for 48 cents. He made over 50% in gains, but the stock was selling for $6 in 1995. So even though he pocketed a great profit, he could have done a lot better. This is a common theme that Mohnish Pabrai has talked about in a few recent interviews. Mohnish is another great investor that has a really good track record. Mohnish talks about how his philosophy has changed over the years. He used to buy undervalued companies and sell them once they got to fair value. That's kind of the usual value investing type of philosophy. But when you do that, you've got to pay capital gains tax. And also you have to do a ton of research on investing in the next company. So it's not a very efficient way of investing. So instead, Mohnish now tries to buy undervalued companies that have a huge runway. That means that they'll be able to maintain their competitive advantage or moat for another 10 or 20 years, which is a long time for them to compound earnings. This 100 bagger book talks about that same concept. For a stock to return 100x, you need to hold it for a long time. Let time be your ally. As an individual investor, you don't have to answer to clients on a quarterly basis. That's a huge advantage. So if you've identified a 100 bagger, it's important to be invested for a long time and to ride out the volatility. The tricky part about holding an investment long term is that you need to expect a bumpy ride along the way. The example from the book is if you look at Apple. From their IPO in 1980 to 2012, Apple returned 225x on your initial investment. A $10,000 investment in Apple at their IPO would have yielded you $2.25 million in 2012. But during that time, you had to not sell during 2 periods where the price dropped by 80% from peak to trough. And you also would have had to hold on without selling through multiple periods of 40% declines for the stock. Can you imagine how hard that would be? Seeing your stock go down in value by over 80% and holding on for the long term. It would be super hard, and that's why it's really difficult for people to get 100 bagger investments. People usually will just get impatient and they get fearful, and then they sell, which means they stop the compounding process. Another thing that I wanted to get into is to discuss some common themes for 100 baggers from a CEO's perspective. One of the really common things is to have skin in the game for the CEO. Now, let me take a quick step back. One of the most important elements for a business that does well is to make sure that the incentives within the business are all aligned correctly. You want the CEO and top management to have skin in the game. You want them to have a big stake so that they can really benefit from the company doing well. Charlie Munger talked about how important incentives are. We've covered his thoughts on this topic in episode 5 of the podcast. As a quick recap, incentives are really important, and if you want to predict someone's behavior, look at where their incentives are. People in general are way more likely to take action when they get something in return for taking a specific action. This is why having management own a large part of the company, like 20 or 30%, is a really good sign. They're going to fight like hell to make the company a big success. This takes me back to a quote by Peter Lynch where he says that management can sell their own stock for any number of reasons, but they're only going to be buying it for one reason, because they think it will go up. So yes, if management is buying their own stock, that's a great sign. If they own a lot of the company, that's also a good sign. That means they have a big incentive to take actions that will increase the value of the shares. One part of the book that I really enjoyed was where the author was talking about CEOs as capital allocators. Because when you think about it, one of their most important jobs is to allocate capital within the company. So essentially, CEOs have 5 tools when it comes to capital. They can invest in existing operations, acquire other businesses, they can pay out dividends, pay down debt, or buy back stock. CEOs also have 3 ways to raise capital. They can either issue shares, issue debt, or tap the cash flow that's already in the business. So the book says that some of the best performing companies have CEOs that really think about the capital allocation component. I'll give you a simple example. Let's say the company can borrow at 2% and they get a 10% return on their current operations. So the CEO can borrow at a lower price and invest in the business. That will create value. The great CEOs that had these 100-bagger companies focused on value per share instead of just focusing on the overall size or growth of the business. They focused on cash flows instead of just focusing on earnings. One example is Henry Singleton, who was the CEO of Teledyne. He didn't pay dividends, he ignored reported earnings, and focused on cash flows of the business. Over time, Teledyne bought back 90% of their stock. If you put $1 into Teledyne in 1963, you'd have $180 by the time Henry retired in 1990. And the crazy thing is that Teledyne was a conglomerate. It wasn't some sort of unique, special type of company. So if you're looking for a 100-bagger, it's a good idea to look at how the CEO thinks about the business. Are they focused on increasing value per share or just making acquisitions to grow their empire? Are they improving the cash flows of the business over time? Those are good questions to ask. Now, one mistake that some people might make when looking at 100-bagger type of companies is, let's say if you're studying companies that became 100-baggers, sometimes you'll see a mining company that just got lucky. Let's say they bought the mineral rights of some land and it ended up having a huge amount of oil or gold reserves. That's more like winning the lottery, and it's not really an investment process that you can replicate. So the process for finding 100-baggers is more about understanding the business at a deep level and picking companies that have durable moats and compound capital at a high rate. So if your goal is to pick out companies that are 100-baggers, there are times that you're going to make mistakes, and Chris addresses this in the book really well. So if you realize that a mistake has been made, what's one thing that can show you that you need to move on? Well, one classic example is if the moat of the business is shrinking. We've talked about moats in episode 8 of the podcast. The moat is essentially the competitive advantage that a business has. The moat can be a strong brand name, or it can be a network effect, or it can be high switching costs. Those are just a few examples. Essentially, the moat allows the company to make better returns than their competitors. Since hunter baggers generally take a long time to give off those amazing returns, you want the company to have a sustainable competitive advantage for a long time. You want your potential hunter bagger to have a really durable moat. As an example, if the stock goes up by 20% per year, it will take 25 years to get a hunter bagger. That's 25 years where the competitors are seeing the company doing well, and the competitors are licking their chops and launching their own products and services to steal market share. So as a company, you need to have a really wide or durable moat in order to still be at the top 25 years later. Thanks so much for listening. That wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button. Thank you, and I hope you have a great day.